common questions that we get from clients when we sit down with them is how should I take income? Where should I take income from? How should I grow my assets? Insert any question that might come up about finances. And a response that we typically have is not all dollars are created equal. So think about that question, right? Not all dollars are created equal. A dollar equals a dollar, $2 equals $2, etc. What we're referring to is the taxes that you pay on those dollars, right? If it's a pre-tax asset, whether it be a 401k, IRA, TSP, etc., those are pre-tax, meaning when you take a distribution, you're going to pay ordinary income on those. And the larger the distribution you take, the higher the tax you have to pay. With a Roth IRA, we need to look at that. That's going to continue to grow tax-free for your lifetime, and then upon your passing, your beneficiaries will actually inherit it after a period of time, tax-free as well. When we build a strategy for you that's customed, would be the right word, to your plan, and we're looking at what is the right fit, where people miss the boat, where people miss on their targets is they're not looking at the tax piece that needs to fit into their plan. What I mean by that is we need to look at not only the time horizons of when you want to take money and how you want to take money, but what tax ramifications do you want to have as well? Let me tell you a quick story. I was sitting down with a client and he was talking about retiring. He had saved for years and years and years. He was going to have a pension and he wanted to delay Social Security. So he was retiring at age 62. His pension, let's say, was $4,000 per month, and his wife was no longer working. His thought process was, I'm going to spend my Roth IRA because I don't want to pay any tax. And I sat back and I said, I love the strategy of you retiring, but we need to do the exact opposite of what you're discussing. And he looked at me because I'm the first person that said that. And he said, if I take out of my IRA, I'll have to pay taxes on that money. And I said, exactly. I said, right now you are in the lowest tax bracket you are ever going to be in, right? The only income you're going to have is your pension, which means you're in the lowest threshold. In the future, you're going to turn on Social Security, which is more earned income, higher taxes. Your wife is going to turn on Social Security, which is more income, higher taxes. We want to pay the least amount of money we can on your IRA. Hence, we take the distribution now. When Social Security kicks in and you no longer need to touch the IRA, then we can turn it to reinvestment so it can continue to grow. What it also did for him is it reduced his required minimum distribution basis to a smaller number. So he didn't have so much in the pre-tax bucket. We were able to take less money, which means pay less taxes later on in life, meaning more assets can be passed on to his loved one, which was his goal. We also were able to allow his Roth to compound and grow for a longer period of time, meaning more tax-free money left to his beneficiaries. So when I say not all dollars are created equal, how you take the money is extremely important. When you take the money is extremely important, but why you're taking it is the most important question. So we need to assess where the asset's coming from, how we take that distribution, and then when we turn it on. Now, in addition to that, there's different vehicles out there that need to be planned for accordingly. Many highly compensated executives have deferred comp plans. You have to choose when you take a distribution from those ahead of time and why you're taking that distribution. It's very difficult to change that because there's a waiting period after you make the adjustment. When we're accounting for that in the plan, what we're doing is we're already laying out the foundation years ahead of retirement to know what your income's going to look like and why. Okay? In addition to that, there could be what are called restricted stock units, and that's something we need to look at as well. A restricted stock unit is a benefit for highly compensated people at a publicly traded company. When you have those, there's what's called a vesting period, and there's what's called long-term capital gains, if you hold them for more than 1 year and 1 day, or short-term capital gains. They're taxed completely differently, and I have seen so many clients make the mistake of choosing the wrong option. It's extremely important to plan because there's significant tax savings if done a proper way. One of the strategies that we talk about with our clients is what's called tax loss harvesting. If you have after-tax assets and you are looking at those and harvesting some gains and some losses, as long as they're like to like, meaning both long-term or both short-term, they can offset each other, which is a huge tax savings for you as a client. One of the other strategies we discuss is what's called taxable turnover inside of a mutual fund. A mutual fund, many people think of as just a bucket of assets that holds stocks or bonds. But inside of there, there's also a fund manager that you never see and don't know that he's placing trades inside of that fund. A mutual fund is one of the only investments that you can actually lose money and still have to pay a capital gains tax at the end of the year. Think about that. You lose money but still owe the government taxes because someone placed trades on assets that have been held for 20 years inside of the fund. It can be extremely inefficient if not used properly inside of your plan. When we bring all of these together and we start looking at each in their own individual compartment, what it does is it starts to create compounding efficiencies for your plan. You are stacking efficiency on top of efficiency on top of efficiency, and all of these small nuances, all of these small wins add up to be a big dollar or a big win for you and your plan going forward. If you have any questions, please feel free to reach out to us, as there's a multitude of tax efficiencies to explore because not every dollar is created equal.